Mike Douglas is Michigan's retirement coach.
Many retirees do not touch their IRA money or 401k until they hit RMD age. And is that a mistake? We are going to ask Mike Douglas this very question. I'm Heather Branch. He is a certified financial planner here to share insight with you, thinking about your retirement years, the goals you have for those years, how to get your money to work for you to help you reach those goals. If you have questions, you can begin the conversation anytime. Find us at michigansretirementcoach.com. This percentage, this study done by JP Morgan Chase, when I read this, I have so many questions because we know when you hit the age of 73, the government starts to force you to take your money out of your 401ks and IRAs. It's called an RMD, required minimum distribution. But this study by JP Morgan Chase found that over 80% of people do not touch their IRA money until they get to RMD age. And even then, they only take the money that the government tells them that they have to take out of it.
Yeah.
Which, like I said, I have many questions. Do people not need it, or are they afraid of using it in case they do need it and they're just kind of making ends meet with savings and Social Security up until that point? And then also, some do say that this is a mistake, this approach. Well, what do you have to say about this information?
I think that a lot of people are afraid of running out of money.
Sure. Everybody is.
That studies show that that's the largest fear of retirees. It's not dying.
People
it's not
are more
healthcare,
afraid of retirement than they are of death.
Yeah. And it's crazy to think that. And then the withdrawals from the accounts to them reflect a negative decision. We spend all of our careers putting in and don't touch.
Okay.
Then you get to retirement, and a lot of people still feel like, I can't touch because what if? What if I make it to 100? What if, the market crashes and all of this stuff?
Mm-hmm.
And that's a very fair concern.
Mm-hmm.
But what we want to understand is that the money is there for you.
Right.
Unless you have a very specific goal of leaving a lot of money, which is fine. The money is yours. You saved it, you earned it, and now it's time for you to spend it. So we always encourage people to spend it, not save for someone else, but spend on you.
Mm-hmm.
But if you don't have a need for it, if you just flat out don't need the money or you don't have desire, then people come in and say, now I'm just frustrated at the taxes. That's the thing I wish I could avoid is the taxes.
Mm-hmm.
So as we look through that, I kind of want to dial in on if you're taking the RMDs and you don't want it or don't need it, right? If that's 80% of the people, then let's talk to the 80% for just a second. If you're the 20%, use it, spend it, do whatever else. If you don't want to pay the taxes, you want to consider qualified charitable distributions. Now, I'm not by any means telling you to do them, but I'm saying you should consider them.
Okay.
Qualified charitable distributions are a great tool that you can use to avoid taxes, lower your adjusted gross income, lower your tax brackets, all the while still satisfying your required minimum distributions. What's interesting is by the time we get to a certain place, we're retired, we get our pensions, our Social Security, whatever sources of income you're receiving, and then they make you start taking money out of your IRAs, your 401k type accounts, the pre-tax accounts. You have to take money out. They don't care what you spend it on. It just can't go into a Roth IRA. You have to pay taxes on it. It can go back into a brokerage or whatever else, but you have to pay taxes on this tax-deferred money. And some people say, well, I'll give it to charity, which is great. Then they take the required distribution and the government takes their cut. And then you give the money to charity of what's left. And then you get a donation receipt from the charity. You go back to the government and say, I donated this money. Okay, great. Then you get a tax refund on some of the money, typically not all of it. So the issue I run into is two things on this.
Okay.
Number one, the charity gets a little less. And number two, the government still gets to borrow your money for the year.
Yeah.
I don't like either one of those things.
Okay.
So what we look at is qualified charitable distributions. It's where instead of taking the money out and then giving it to charity, it goes directly from your account right over to the charity or to the church or to the nonprofit you want to give to.
Okay.
And as a result, they get the whole money. So let's say, for example, your required distribution for the year is $20,000. In a typical model, you take the 20, they withhold taxes, and so you get 15. And of the 15, you give it to charity. The charity gets $15,000. At the end of they give you a donation receipt. You go back to the IRS and you say, I gave this $15,000 away, and they give you a tax deduction on $15,000. So then when you get your deduction back, it's like you made $15,000 less, not $20,000 less, $15,000 less, and it helps you in your tax situation.
Yeah.
That's scenario A. The preferred scenario is you say, I don't want this $20,000 to begin with. You do a qualified charitable distribution directly over to the charity. The charity gets all $20,000. The RMD is satisfied.
Okay.
And you have never paid taxes or been taxed or anything. So a larger chunk of money goes directly to the government, or directly to, not the government, directly to the charity.
Yeah.
And so when you do it that way, the charity gets more, you satisfy the distribution, but most importantly, it doesn't factor into your scenario at all.
Got it.
There's not this withholding and then trying to get a refund and free loans to the government. None of that.
Okay.
It goes straight to the charity. Things you need to know about qualified charitable distributions.
Yeah.
Number one, you must be 70 and a half years old.
Okay.
Which they have not updated that number. They need to update it to 73, but 70 and a half. The maximum annual QCD you can do is $100,000 per person. So if your RMD is $120,000,
yeah,
you can't do 120. You can do 100 per year, and then you have to do the tax element on the 20,000. Still better than getting dinged for the whole thing.
Mm-hmm.
That's it. Now, as a married couple, you can do $100,000 each.
Even if it's coming from the same account?
No, it can't come from the same account because this is required distributions, separate people's IRA monies.
Okay.
But at least it's like, between the two of us, we've got this, whatever, we have to take out. Well, you both can. So it's not a married couple can do 100,000. It's each individual can do $100,000. It does count towards it. In terms of tax benefits, it's not included in your taxable income, unlike regular IRA withdrawals. So this can lower your AGI, your adjusted gross income, potentially reducing your tax bracket and other liabilities. You don't need to itemize for qualified charitable deductions or distributions.
Mm-hmm.
You don't have to itemize for it. It's just an automated thing.
Mm-hmm.
There's a lot of stuff that can go, but most importantly, it's a direct transfer. It's from your IRAs to the charity.
Mm-hmm.
It's from Schwab or Fidelity right over to the church. So as a result, there's no way it's a taxable event to you.
Got it.
You can't, and it's just a whole different model.
Mm-hmm.
You do still get a 1099-R that is reported to you. So Schwab will issue you a 1099-R as a normal IRA distribution. It's important to know that because people get frustrated. They get their 1099 and say, I thought this was a QCD. Why did I get it? You still get it reported.
Okay.
Then you have your tax advisor report that it's a QCD, properly reported and excluded from your taxable income.
Okay.
So it's kind of this weird space where it seems like it's good and then it seems like it was done wrong, but then you just title it properly on your return.
It's just a little extra paperwork in between.
Yeah, but at the end of the day, the charity gets more money, your RMD is satisfied, and you never
not seen
pay
as taxable
taxes
income.
on it.
Okay.
Right.
Okay.
So those are the big ones. It's got to go directly to a 501c3. I really encourage people. I mean, it can't go to donor advised funds, private foundations.
But that's what I was going to say. You can't just give it to. You can't have your grandkid go set up some for non-for-profit
thing. The Douglas 501c3. Yeah, exactly.
It's got to be of a certain tier. It's like instead of Cars for Kids, it's Cash for Kids, and it's My Kids. It's my RMDs, and it's KASH. Yeah. And so wasn't that so cute? Mike's 40-year-old children are collecting on this thing. No, it has to be a legit thing. Yeah.
And you need to be not involved. Yeah. And you need to. And again, the whole goal of this is to do good with money.
Yeah.
Is to be part of something bigger than yourself. Yeah. And do it in a way where the government doesn't get to tax you.
Yeah.
Because remember, it went in tax deferred, so you never paid taxes, and it gets to come out tax free. That's pretty nice.
Yeah.
And that's a good thing. So if you're at that point of not needing required distributions, if this is all still very confusing to you, I get it. We have a lot of content information about it. Subscribe to this channel. If you want to direct message us, reach out to us, michigansretirementcoach.com. We can help you understand it a little better. But there are some rules to it.
Yeah.
But our clients really, really enjoy it. And sometimes they I have one sheet every year in January, sends us a list. Because a lot of people like to get it done early in the year.
Yeah.
Just to, one, satisfy it, but two, just lowers your AGI and things for the year.
Okay.
But she sends us this list of about 15 to 20 charities every year.
Cool.
And she's really glad that they can do good with her RMD.
Yeah.
And so we send it out, get it out to them very early in the year. And from there, everything's good to go. So it's
if
a great
somebody,
opportunity.
but it's because I think that also some of the details that we've gone through, somebody listening to this or watching this is like, golly, that sounds like a lot of work. So basically what you're saying, if for somebody that works with you, she just emails you a list of charities. She's like, this is what I want. And that's it for her. You handle the rest.
Yeah, so there's a process we go through because these forms have to be signed,
Yeah.
right?
Okay.
And so, but she sends us the list of where she wants it to go,
Yeah.
and then we put the list into the documents, and then we just have a little signing party. She comes in about 10 minutes. She goes, and then we're good.
Okay.
But from there, it gets done really easily.
Okay.
But again, that's only because we've gone through and had these discussions to the point where she's very confident and understands exactly how they work.
Yep.
And so when it's in year 4 or 5, it's a really automated system.
Yeah.
But year 1, when we did the same thing for her in year 1,
Yeah.
we got it. We submitted all. And then she got her 1099 and said, what the heck
Why is
is
this?
She said,
You said we were going to be good. Why am I getting
you
this form?
promised me.
How dare
promised.
you? You sit
Yeah.
on a throne of lies. It smells
Yeah.
like beef and cheese.
But it was just, hey, I told you we did this. Now we're going to go to your tax guy. And the tax guy goes, yep, you did it right. Now we file it this way. So now she's just like, here comes the 1099, but it's a pretty easy process once you understand it.
Okay.
But it's important just to keep as much money in your control, out of the government's control as possible.
Yeah. Obviously, goals for all of us to control. I say it all the time. It's your money. You worked hard to earn and save it. You should be in control of it. You should know that it's doing what you need it to do and what you want it to do. As Mike was pointing out, lots of ways to reach out to him. Links have got posted in the show notes. You can click there if that's obviously easier. But the website, as always, find us there anytime, michigansretirementcoach.com.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit michigansretirementcoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.